I was just describing the market as, perhaps a little bit light on volume. We needed a relief rally. We're getting it.
Yes.
But is it a dead cat bounce? And why don't we even explain what that might mean to some of our viewers?
So the rally is pretty broad-based. We're seeing it across all sectors. You had mentioned energy, tech, some of the financials. So we are seeing it across all the sectors. But what really concerns me at this point is we're not seeing volatility. We're not seeing the VIX actually down as you might think it would be on a major rally like this. We're still seeing the VIX extremely elevated, well into the 20s. That is still a concern for me.
Why? I mean, when I looked at it, it's down by about 12% or so, but to your point, it does have a two handle on it. Why is that a concern, or what is it telling you? What are you going to be watching for?
It's just telling me that the near-term volatility is still there. It's still present. There's so much headline risk coming up. We have our midterm elections, in the next couple of weeks. We still have the November 4th sanctions with Iran coming up. Plus everything else that's going on with the Fed, the battle with President Trump in the Fed, rising interest rates, although they've curtailed for a bit. There's still so much headline risk. There's going to be near-term volatility. I'm not suggesting we're going to see the market down 1,000 points, up 1,000 points, but the fact that the VIX has not come down below that 20 handle to me suggests in the near term here, expect some more turbulence.
Let's talk a little bit about why we've even been seeing some of the turbulence. It certainly seems as though more and more investors are focused on the uncertainty, even though the uncertainty has been there essentially throughout the entire year. Yesterday, though, was a key day in terms of investors saying, wait a second, I want to lock in some of my profits.
No doubt about that. But, today you have what you called earlier, this dead cat bounce or some of this relief rally. And when you get a dead cat bounce, and you wanted me to explain that, it's like you said, it's not with much conviction behind it, meaning there's not a lot of volume behind that. So even though we're seeing a broad-based rally today, you want to see that with conviction. You want to see heavy volume coming in, and we're just not seeing that. Now, let's see what happens after the close today, because two of these bellwethers, Amazon and Alphabet, they're reporting earnings. And let's see what they have to say about future guidance, because that has been obviously some of the softness, some of the weak spot that we have seen in some of these big companies that have reported already.
What other weak spots are you focused in on? I mean, one thing that I keep reading about are the new home sales or existing home sales in the United States, that there is actual softness in the housing environment in the United States. Some are attributing that to a great run-up over the past number of days, but on the other side, too, you actually might start to see some people feeling the effects of higher rates in the United States.
No doubt about it. I mean, the housing market has been just awful here. The numbers have been just awful for quite some time, and that just got reinforced yesterday with some of the news that came out. So that market is really, I'm not going to call it down at a bottom just yet. I do think that we may be approaching a bottom in the housing market if we see rates especially just start to curtail a little bit, start to level off, and maybe we get just some not necessarily dovish speak out of our Fed, but if they're not quite as aggressive, we may see some home sales start to pick up. Now, I really like the energy space here. I think on the upside here, energy has just been beaten down and beaten down. I think this is a good spot to look. Now that we've seen the oil market really back off a little bit, stabilize a little bit, I'm not saying that we're going to rally back up, on West Texas back to the mid-70s or so, but I think that's a good spot to put your money right now.
Scott, one of the things I'm thinking about is what this market really feels like. And to me, it feels a little bit like, I would say 2002. Others might say if you're going to go down that path, it's more like 2000. But to me, it feels like 2002. I had David Rosenberg on with me yesterday, who likened it to 1989 and 2000. Just in terms of these moves that we're seeing, these wide swings. Goldman Sachs had a really interesting report out talking about these major moves and whether we're going to be flat and skinny or, all these different ways to describe the market. But essentially, we're going to be very volatile and range bound, and essentially you don't make a lot of returns in the equity markets for a certain period of time. What does it feel like to you on the floor there, and you've been in the business for a long time?
I have, and I was on the floor back in '89 and in 2002 when we went through both those periods. This does feel different to me. It does not feel the same, and the reason I say that is because there is a lot of two-way paper here. Even though we're getting these big volatile moves, and when we see 500-point moves, that sounds so large. But when you take that into consideration, we're talking 2.5% moves. We are seeing that, but you also have to remember, we're seeing these moves after just such an extended period of time of lack of volatility. We went through, the past 12, 18, even 24 months, with the exception of just a few blips in there, of just massive low volatility. So I'm not saying that the market is catching up to that, but I think that this is just a little bit of kind of that average over time of what you see. But I don't feel that this is the same as either back in '89 or 2002.
So where does that lead you in terms of how much exposure you want versus how much profit you want to lock in?
Sure, it leaves me very cautiously optimistic. I say cautiously optimistic because we have a lot of wild cards out there. The Fed, the tariff talk, most importantly to me. And what's really disturbing about tariff talk now is that you're seeing all of these big companies mention it repeatedly now, over and over and over in their earnings reports. So they obviously are very concerned about it. That being said, there are a lot of stocks on sale out there. There are a lot of sectors on sale. I'm not saying that you just go in hand over fist and put in 100% of your allocation right now. But boy, oh boy, the fundamentals overall are still pretty decent. Yes, rates are rising, but the economic fundamentals, the market fundamentals are still pretty decent. Are they as robust as they were 9 months, 12 months ago? No, probably not. That being said, I think that we have seen an overblown correction here. Now, the rally back today, maybe too much too quickly on the rally back. But overall here, I think you're okay actually allocating, if you have some cash on the sidelines here, starting to pick up some names that have been on sale.
Okay. And Scott, last thing I was thinking about this as well in terms of what might help the market decide what the true trend will be. I think it's going to be the consumer discretionary companies reporting their recent results because, there's been a lot of focus on the consumer in the United States. It's over 70% or so of the U.S. GDP, call it 70%. That's going to be key and critical. We're so focused on tech. We're so focused on the semiconductor companies. But the consumer, how does the consumer right now feel in your mind?
I totally agree, and I think they're still, I'm going to say cautiously optimistic as well. They still feel pretty good, but the concern of rising rates, the concern of the rest of this headline risk has definitely started to seep into Main Street. Okay, 3 months ago, everybody was looking forward to the holiday season coming up. Spending was going to be up. Everyone had a little extra discretionary income. I think people are starting to think twice a little bit about that now. Still feeling pretty good, not as good as they were a few months ago. So I think you're spot on that some of these stocks in that sector, we're going to have to really watch closely here to see how the consumer reacts to that.